What's up, everyone? Dylan here. I wanted to hop on for another episode of the weekly analysis video. With that said, we'll hop right into it. Last week, we had an abbreviated holiday week where we saw much less volatility compared to the weeks prior. So, for a brief reminder, I showed you guys that the S&P, right, this rally here that occurred about 2 weeks ago, got right up to the 50% retracement from February highs to April 6 lows. Okay, so last week I said, hey, if the bulls can manage to get above that 50% fib level, right, that sits at 5525 on the S&P futures. I said if the bulls manage to break above there and sustain value, and it leads up to these that deadly cross where the 50-day and the 200-day are kind of aligning, I said I would want to sell into that rally. Clearly, we never got there, so that never occurred. But that still remains a something that I'm looking at going forward. So if we do get a rally going forward, if it occurs this week, that is still something that I'm interested in doing. In that I would actively be looking for a place to sell up there that had appealing risk to reward. Okay, so that still stands. What happened from the last time I spoke to now, right? Again, there was much less volatility last week, but there was still a decent amount of news flow and things that occurred. So for one of the big reasons that the market was down last week was there was the United States issued new limits and restrictions on AI chip exports to China. Okay, that came out Tuesday after the close, which resulted in this gap down. So Tuesday after the close, the United States came out with that news, and basically it affected NVIDIA and AMD as well as some other semiconductor names, and ultimately that news put a massive burden on the overall technology sector. So what's interesting is the fact that the S&P managed to close that gap. You could see the following day, the S&P got right up into that 5420 gap fill, and from there on out, the bears were clearly in control, and they pushed value up until today's close. Whereas the NASDAQ did not fill that gap. So going forward, if and when a bounce occurs and NASDAQ gets up to that 18,930 area, I will keep a close eye on that gap fill. It will be important until it is filled. So on top of that gap fill, that unclosed gap, the NASDAQ also has this trend line where it aligns with as well. So you can see this trend line stemming from February 21st. It tested it again March 25th, and then again April 2nd on Liberation Day, which basically initiated that massive sell-off that we got on Liberation Day. So again, going forward, if a bounce does occur, I definitely want to look at this general area right here, which lines up with that trend line stemming from February 21st and the unfilled gap from the day that the United States put out that those limitations and restrictions on the AI chips being exported to China. Okay, so that's very, very important to the upside. In the very near term, to the downside, NASDAQ also has a trend line that was established back on April 6th, which marked the year-to-date lows. So since April 6th, you could see 1, 2, 3 different bounces there in a matter of a few days. And today we got very, very close to hitting there, but the bulls were able to support the market before it necessarily got there. So going forward, if we do see a dip in the next few days, I would definitely keep an eye on that line, which currently sits at right around 17,684-ish. But it's ascending, right? The line is ascending, meaning as time progresses, it'll go higher and higher. So again, these are the key areas that I will be looking at going forward in the very near term on the NASDAQ. Basically represents the two extremes of the recent range that we have seen, right? The recent range using this large move. This is the day that Trump came out and, came out with that 90-day delay on the reciprocal tariffs. That's basically the range that we've been trading in. We haven't necessarily taken out the high or the low of that general massive vertical rally. So for the time being, the market kind of remains in that general April 9th low to high range. Okay. Same with the S&P as well. So, it's important to keep an eye on that particular day, mark the high, mark the low, and, kind of gauge price action around those extremes if they were to test. So, one thing that's interesting that I have noticed is that there was a point in time, call it, say, 2 weeks ago, 3 weeks ago, where anytime Trump would come out with some type of optimistic news about tariffs, and very broad too, like he would say, tariffs are going well, everyone wants to negotiate, something along the lines of talks have been productive, we're going to reach a deal 100%, right? He was putting out those little headlines on his Truth Social and during press conferences, and the market would react in a very, very big manner, where you would see the S&P move 100 handles in a few minutes on those types of headlines. However, in the last week, anytime Trump says that, it says something along those lines of talks are going productive and just had a phone call with so and so, right? In the last week, the market hasn't even flinched, right? The market, in a way, it seems as though the market doesn't think that Trump is telling the truth, and they kind of don't believe him in a way. So it's interesting because now, and I keep seeing these headlines every single day where, Trump says, oh, just talk to that person, tariffs are going well, we're coming close to a deal. Each time he has said it in the last week, the market says, screw that, and it keeps going lower and lower, making lower lows and lower highs. So the fact that he doesn't have that tool in his back pocket anymore, where he can kind of synthetically create buying pressure, because again, there was once a point where he would put out a tweet on very broad, tariffs are going well, productive talks going, where you would get a really nice short squeeze where the S&P would rally 100 handles. You'd have algorithms buying pressure, adding buying pressure to that, so on and so forth. And clearly the market has not been reacting to those near-term headlines the way that he probably would have liked them to. On top of that, and this also is part of the reason that we've seen the sell-off in the last week. This is from Adam Christofouli. He said, just as the fallout from Trump's April 2nd Rose Garden tariff unveiling, which was Liberation Day, was starting to stabilize, a fresh macro crisis is underway as investors grow extremely anxious about Trump's repeated criticisms of Powell and the threats they pose to Fed independence. This could shatter confidence in America and trigger a further exodus from U.S. stocks, treasuries, and the dollar index. So at least twice in the last few days, Trump has gone on to Truth Social and really talked badly about Fed Powell, saying very mean things and basically blaming him for certain things that he doesn't want to do in the Fed in terms of changing up Fed policy, and it doesn't look good. If whether you're in United States or not, it does not look good. And any tension between Trump and the Fed, on top of the uncertainty with tariffs, it doesn't look good, and this is the outcome that you will have with that. Okay, so again, unless Trump comes out with solid, concrete, real headlines showing actual proof of different countries wanting to come to the table and really negotiate, I don't really see a reason for the S&P and the Nasdaq to rally in a sustainable manner. Okay, now there are one other piece of important market catalyst that is coming to the table this week. Nearly 120 companies out of the S&P 500 report earnings this week, including Tesla tomorrow and Google on Thursday. So when the mega cap names report earnings, they do have the ability to influence overall market sentiment. So that can be good, but it also can add an additional pressure to the market if they do not come out, where they, beat expectations, or even if they're less than feared. They could be blowout in a negative way, where some of the dialogue on those conference calls cause much more fear and panic in the market, where it can add additional pressures to the downside. I don't know what's going to happen with the earnings, obviously, but the fact that a large portion of the S&P 500's earnings start this week is something to look out for. So again, going forward, I will be navigating and looking closely at the NASDAQ. To the downside, you have that trend line stemming from April 6th. To the upside, you have the trend line stemming from February 21st. We're basically in a wedge where the bulls are vulnerable because the NASDAQ is at the lower portion of this particular wedge. So the bulls really have to step in the near term to support the overall market and push value closer to the equilibrium of that wedge, and then to the upside would be most optimal for if you're a bull. To the downside, again, this is the same lines that I've been talking about for the last 2 weeks, which stem from the 2022 highs as well as the 2020 COVID-19 lows, which basically coincide in this 4820 to 4800 area. And then beyond that, or above that, you also have the 20% bear market territory on the cash index as well, which lines up right around 4920. So from 4920 to 4820 is very, very important area for the bulls to defend if it gets down there. So that will be very, very important going forward as well. So again, NASDAQ upside, that area to the down, or that's to the upside. To the downside, that trend line area. And then if that trend line gets broken, the next areas to look out for would be 4900 on SPX, which lines up with the bear market territory, and then beyond that would be that 4820 to 4800, which coincide with the that massive line stemming from 2022 highs and the COVID-19 2020 lows trend line. And again, I want to make this very, very clear. If and when the market does manage to go to the upside, that probably aligns with Trump, releasing solid, concrete evidence that other countries are coming to the table to really negotiate and come up with some deals. If and when that occurs, and the market starts to go to the upside, I still want to be a seller following this deadly cross, right? The deadly cross implies a shift in trend, and that doesn't mean that the market can't rally. It can certainly rally, but I would want to be a seller up at that 50-day moving average or the 200-day moving average based on which one looks better in terms of risk reward, as it has the highest chance of rejecting there on the first retest. Okay. And I know last week I talked about why to sell the rally, and I talked about Tom Essay, what he said. I'm going to say another thing. He said this recently as well, on top of what he said last week. But he said, at a minimum, there are 10% blanket tariffs on imports that will boost inflation, complicate the Fed strategy, pressure earnings, and possibly restrain consumer spending, which all of those combined ultimately lead to stagflation pressures, right? Lower earnings, right? On Fortune 500 companies, or not even Fortune 500, but any company that's publicly traded. Overall, it definitely puts the overall market cap on certain companies at risk. So the valuation for the overall stock market is vulnerable. So that's why I want to, outside of technical reasons, that's why I would want to sell the rally if it gets up to these extreme rally or extreme, points on the chart. So that general area. Okay, so hopefully this was a decent video. I've stuttered a lot in this video. I'm still trying to come back after a 3-day weekend after celebrating Easter and having just that long weekend off. So I've tried my best. So if you like this video, please give it a thumbs up. I appreciate all of your support, and I will talk to you soon. Peace.